Okay, thanks for reminding me. Any other questions on this question? Okay, so this is very important. That will definitely be on your not on your quiz, on your midterm. So make sure that you're comfortable with answering these questions. Um, so let's go back to where we left off. So here in the balance sheet, like I said previously, we have an asset, liabilities, and shareholders' equity. Okay, last week we focused on transactions that relates to accounts receivable. Okay, and that falls under the current section of the asset. Okay, that's a part of the current assets. Now let's look at some of the notes receivables. Okay, that usually lasts longer than accounts receivable, but still usually falls in the current asset category. So but I mean, the idea is pretty much simple. So the only difference between the accounts receivable and notes receivable is the fact that for accounts receivable, usually I talked about this previously, not the deadline, but the due date is usually um, within 30 days or 60 days, okay? For notes, the due date is usually longer than 6 days. Okay, that's the first difference. And then the another difference is the fact that for accounts receivables, you do not pay, or I don't want to say not, you do not pay interest. Okay. Whereas for notes receivable, there is an interest components associated with the notes. Okay, so I mean, technically for accounts receivable, since you're not paying back in 30 days or 60 days, you are supposed to pay a little bit of like interest associated with it. But I mean, we don't really charge credit cards for interest unless you do not pay for the credit card bills. But when it comes to notes, there will be definitely interest components associated with the notes. Okay, and that's what's happening here. Now, looking at this transaction, the company provided $10,000 of services to this customer who is not able to pay immediately. So instead, what the customer is doing is signing a promissory note offering to pay $10,000 plus 12% interest in 6 months. And that's a lot of money, 12% interest. Now, these days, the interest rates are basically zero, okay? But anyways, so after 6 months, okay, this customer will pay back the original principal amount, which is $10,000 plus 12% interest for 6 months. So let me go down a little bit. So at the point of the transaction or at the point of the services, which falls on February 1st, the company or the provider, the service provider will record notes receivable of original $10,000, okay? And for the credit side, you will record a revenue with the same amount, $10,000, okay? And that's easy stuff, right? And since the company is paying back after 6 months, which will be August 1st, okay, the company will receive cash, okay, which will be starting with $10,000, the original amount, and you will reduce your another asset, which is $10,000. Plus, there will be some interest components. Okay, so let's first calculate the interest. So your principal is $10,000 times it is 12%. And keep in mind that this is in annual terms. Okay, annual term. And since this note is paid within 6 months, you're going to multiply by fraction, which will be 6 over 12. Okay, so that will give you, oh my God, $600. Okay, so that's an interest revenue. Okay, So what that means is that for the interest, you are going to receive cash of $600, and that point, the interest component will be recorded as interest revenue of $600. So what that means is that if I can just summarize everything here, the company is receiving cash of total $10,000, 600, and interest revenue of $600, and the original notes receivable of $10,000. So this is the simplified version of a journal entry. And these two separate journal entries are basically the details of what's happening that's associated with its notes. Okay, so it's not that difficult. Yeah, question.
Does it matter which order you put it in, interest received, revenue, and notes receivable, or can you?
What's the question?
Like, does it matter that you wrote interest revenue before notes receivable?
Oh,
No.
doesn't matter. Yeah, the order doesn't matter. As long as the debit and credit balances, you are good. You're pretty much in good
Okay.
shape. Okay.
Thank you. Just
Yeah.
curious.
Any other questions? Oh, huh? Okay. Now, this is an easy case. Okay. So let me just go to, so like you can see right here. So you're receiving cash for the total amount of $10,000, 600. Notes receivable, the original principal amount, which is $10,000, plus the interest revenue for the amount of $600. Now, this is an easy case. What makes students crazy or drives them crazy is the fact that there is a case where the original transaction dates falls in year one, and then the maturity date falls in the next year or year two. Okay, just like right here. So the original transaction happened on November 1st. The customer is paying back in 6 months, which indicates that the maturity date falls in the next period. Now, if that's the case, what are going to be the journal entries that you will be recording at the end of the year? Because at the end of the fiscal year, the company closes the books and they make all these types of adjusting entries and prepare the financial statements. So if this is the case, the question becomes, how do you record the adjusting journal entries as well as the maturity, at the maturity date, the journal entries as well? Okay, so let's basically, I'm just gonna give you the journal entry right here. So, but basically the idea is simple. So assuming that the transaction happened on November 1st, okay, with the same transaction. So the principal amount is $10,000, okay? And that's for service revenue. Okay, you're still recording revenue of $10,000 on November 1st, okay? Now, at the end of the year, which falls on November or on December 31st, 2 months, okay? 2 months have lapsed, okay? So on December 31st, there will be adjusting journal entries with respect to this notes receivable. So after 2 months, you're not getting the principal amount back from the customer because the maturity date is way far away from December 31st. But what you will be recording is something related to this interest, okay? Because during that 2-month period, the interest still accrues from November 1st to December 31st. So for 2 months, you will be recording an interest component. And let's just compute the amount first. The original principal is $10,000. The rate was 12% times, instead of putting 6 here, okay, you're gonna put 2 over 12, okay, because that's for only 2 months right here. So what that means, the interest revenue or interest something receivable, okay, is for the amount of $200. So as an adjusting entry on December 31st, the company will record interest receivables in this case, because you're not getting the interest in cash, but the company is just reporting that I have some receivables that's coming up in the next period for the interest for the amount of 200, and that's interest revenue. Revenue of $200. Okay. And so this is the adjusting journal entry that's reported on December 31st. Okay. Now, after 4 months, okay, so that's going to be May 1st. Okay, first. On May 1st, the company will receive cash, okay, the original principal amount, $10,000, and you will reduce the notes receivable by $10,000. Now, on December 31st, you reported some receivables with respect to this interest. So you're getting cash for 200, and you are, again, will reduce this interest receivables by 200, okay? Now for this 4 months, okay, from December 31st to May 1st, there will be another interest components associated with it, okay? So you will, again, receive cash, not 600 in this case, $400. That's, again, from the original principal amount times 12% times 4 months over 12, okay? That's for the interest, and that's interest revenue of 400. So this is a journal entry that's going to be recorded on May 1st. Now it looks very complicated. If I can simplify it, basically you have cash debit of 10,600. You are recording interest receivable by 200 and interest revenue by 400. Okay. So comparing this with, let me just go up, with a transaction that happened within the same period. So originally, on the previous cases, you only reported this interest revenue of $600. Now I forgot to do notes receivable, by the way, $10,000. Okay. So on previous case, you only reported this interest revenue for the amount of $600. Now in the next case, because you made an adjusting entry on December 31st, you only report $400 for interest revenue, and for the rest of the 200, you're going to be recording a credit to interest receivable. Okay. Any questions on this?
In this case, Professor, we're supposed to record the interest revenues separately since they're from two separate.
Yeah, so the interest revenue of $200 right here will be reported according to this question 2021 income statement. And the rest, 400, will be reported under 2022 income statement. Okay. Any other questions? Okay, so concept check. So the company accepts a notes receivable of $5,000 on September 1st, 2021 that matures in 10 months and has stated interest of 6%. What amount of interest revenue will company record in 2021 and 2022? So I'm not going to go through these journal entries, but basically what's happened here is that the transaction date was on September 1st, okay? And there will be adjusting entry on December 31st. So that's 4 months of interest accrued. And since the original notes matures in 10 months, there will be the other 6 months of interest accrual. So that's going to be July 1st or December or June 31st, depending on how you put it. But anyways, so from September 1st to December 31st, the interest revenue that accrued for that period is 5,000 times the rate is 6% times it's for 4 months over 12. So that's 100, if my calculation correct. So that's going to be the interest revenue in 2021. And for the other component, again, the principal amount is $5,000, 6% times that's for 6 months over 12. So that's 150. Okay. Oh, basically, the answer is here. So for 2021, you have an interest revenue of $100. For 2022, you have an interest revenue of 150. Okay. So easy peasy, hopefully. Any questions?
Was there a journal entry that's supposed to go with that or no?
Oh yeah, there will be a journal entry. Do you want to see the journal entry?
Yeah, come on.
Okay. So so for the first part or the first period, the journal entry will be interest, in this case, receivable, because you're not getting the interest in cash for that year. So you're going to be recording a debit to interest receivable for $100 and interest revenue of $100. Okay. In 2021. Okay. For 2022, you are going to be recording here. It's not interest receivable because you're actually getting the cash because the maturity date falls in that year. So you're getting cash of 150 and interest revenue of 150. That's the first one. Now, second one is that last year you reported some receivables for the amount of 100. So you're getting another cash of 100 and you're going to be reducing this receivables by 100.
Thank you.
Yeah. Any
If
other questions?
you recognize all the cash in the maturity date.
Yeah. I mean, depending on the terms or the payment terms in the notes,
Sure.
but mostly we assume that the repayment will fall in the maturity date.
So you go from a receivable to cash at the end.
Yeah, because on December 31st, 2021, you're not getting the cash from the customer.
Yep.
That's why you're just reporting something receivable related to interest.
Thank you.
Any other questions? Okay, so I think that's it for chapter 5. Yes, I talked about this percentage credit sales. So just to remind you guys, so we covered 3 methods. So unrelated to these notes, we covered 3 methods. Okay, 3 methods for estimating uncollectibles. Collectibles. The first one is the percentage of accounts receivable method. The other method was the aging method. And as an appendix right here, we also discussed the percentage of sales method. Okay. These two are pretty much similar, but this is different. So make sure that you understand the difference, the major difference between the balance sheet approach and the income statement approach. Okay. So that's it for chapter 5. Any questions? Okay. So we talked about sales and services and how that's impacting your accounts receivables and estimating this on collectibles. Now let's move on to another line item, which is the inventory. Okay, so as you're making sales for products, your inventory will be reduced. And as you are reducing your inventory, you're also at the same time will be recording what is called a cost of goods sold. And then the lessons that you're going to be learning in this chapter, there are, again, various methods to estimate the cost that's related to the sales. And we're going to cover them today. Okay. So understanding inventory and cost of goods sold. So learning objective is to understand that the inventory flows from manufacturing companies to merchandise companies. So not that important. I don't think this is important. But basically, inventory includes items that companies intend for sale to customers in the ordinary course of business. So basically, inventory is any items that the companies sell to customers. Now, when it comes to Apple, I mean, obviously, iPhones and iPads are the types of inventory company will be reporting. For Tesla, Model 3, okay, Model 3, Model S, Model X, or Model Y are the types of inventories the company will be reporting. Now, what you may not understand is that for inventory, okay, we are not just simply talking about this final, okay, or finished goods, okay, finished goods. Actually, if you take a look at closely, what inventory actually is that within the inventory, there's a raw material, okay, there's a raw material, there's a work, let me just write in full name, work in process, okay, that's reported under inventory, and there's a finished goods. Okay, so if I'm using Tesla, for example, okay, so under Tesla, for Tesla company, within the inventory, finished goods basically is the cost of the Tesla Model 3, okay, Model 3 or X, but raw materials, the company will be reporting costs related to, for example, aluminum, okay, or steel, or some camera lens. Okay, all these raw materials will be reported on their inventory. So work in progress process, the costs related to direct labor or rent expenses, electricity bills. Okay, so some cost that's basically converting this raw material to finished goods are also reported on their work in process. Okay, so for inventory that the companies are reporting in the financial statements, it's the total amount, it's the sum amount of these three types of inventory, I guess. Okay, so raw material, work in process, finished goods. Now for this course in particular, we are not going to be really focusing on raw materials or work in process. We're just going to be focusing on this finished goods and how that's going to be computed as the sales are made to a customer. Now, I think most of you will be taking the next accounting class called managerial accounting. In that course, next semester or the semester after, you will have a very detailed discussion of this raw material, work in process, how you're going to compute the dollar amount for raw materials and work in process, and by how much that's going to be reported in the financial statement. For this introductory course, we're not going to really talk about these two, but we're going to focus on this finished goods. Okay. Any questions? Okay, so why don't we take a look at the real world example? Because that's something that I really like. So obviously we have Tesla's financial statement. If I remember correctly, we have a detailed description of inventory. So according to Tesla, okay, you have an inventory for the amount of 3,000. Well, let's just put it to 3,552. So let's see if this is the number that you see in the balance sheet, because inventory is the number you are seeing in the balance sheet. So remember 3,552 for inventory. Let's just go up to this balance sheet. Okay. So for assets, inventory, as you can see right here, this is the number that's reported, 3,552. But in reality, 3,552 is the total amount of raw materials, work in process, and finished goods. And for this Tesla company particularly, they also include the service parts. Okay, so when companies talk about inventories, it's not just the finished goods. You're actually talking about the raw materials, work in process, and everything else. Okay, so that's something that you have to understand in interpreting or understanding the financial statement. Okay. Now, in this case, since Tesla is a manufacturing company, that's why you are seeing this raw material, work in process, and finished goods, detailed description of the inventory. But we have actually two types of companies. You have manufacturing companies, just like Apple or Tesla, and there's a merchandise company, types of company, merchandise. So for example, Target or Best Buy, okay? Actually, yeah, these companies are not actually manufacturing products. They are just retailers. So they just receive these finished goods from the manufacturing companies, repackage or arrange items on the shelf, and they just basically deliver the products to the customers. So in this case, for merchandise companies, they don't really report this raw material or work in process. They only just report inventory, which basically equals to the finished goods. Okay, so that's another thing that you might want to know for different types of companies. And let's talk about cost of goods sold right here. Okay, so when the company sells products to customers, okay, so what that means is that when there's a sale, okay, your inventory will go down. Obviously, you're selling your inventory, so that will definitely reduce the inventory. So at the same time, as you are reducing your inventory, you're also going to report this cost of goods sold, or I usually call it COGS. Or sometimes, yeah, some other accounting professionals prefers to call it cost of sales. Okay, sales. So they are interchangeable, but basically cost of goods sold, COGS, or cost of sales, costs are basically the same. But what you need to know is that as the inventory goes down, you're going to be recording this cost of goods sold to show that you are incurring the cost that's associated with the sale of the product. Okay? And this cost of goods sold is reported as an expense in the income statement. So inventory is a balance sheet item. Cost of sold is an income statement item. Something that you might want to know. So I talked about this previously. So manufacturing companies, they report three types of inventories, whereas for merchandising companies, if you're a retailer or wholesaler, you're just going to report inventory per se. That's it. Okay. So this is a brief description of an inventory. I don't think I have to explain this, but basically, if you're a manufacturing company, just like Intel, there will be raw materials, work in process, and finished goods to give you the total inventories amount. Whereas for Best Buy, which is a retailer, you're just going to report this inventory in lump sum amount of that. Okay, that's the difference. Yeah, this is not necessary. But basically raw material, again, raw material, work in process. This is something that you will be learning in the managerial accounting in the next semester or the semester following. Okay. Key point, not important. So let's go to the concept check. Which of the following inventory accounts consist of items for which the manufacturing process is complete? So basically, you're talking about manufacturing companies. Okay. When the process is complete, you're going to be reporting this finished goods. Okay. Any questions? Good. Um, so for the next part, I'm going to be talking about the structure of an income statement. Okay. Now, before we get into this income statement, now this graph looks very complicated. So basically what this illustration means that we have inventory of T account. Okay. So for T account inventory, you have a beginning balance, okay, that's reported the end of the last year or the January 1st of this year. There will be an ending inventory for inventory. Now, if you purchased inventory during this year, you are going to be recording this purchase in the inventory that will increase your balance of inventory. And at the same time, on the other side or the right side of inventory, you will be recording this cost of goods sold. As you are selling your inventory, you are going to be recording this cost of goods sold on the credit side or the right side of the T account. That's basically what this is. Okay, so you have a beginning of 20K, okay, and you purchased inventory during the year by $90,000. So basically what that means is that the company has a total of $110,000 of inventory that's available for sale, okay? Now during the period, the company sold $80,000 of inventory. So that's going to be reported on their cost of goods sold. So at the end of the day, the ending balance of inventory will be $30,000, okay? So given this T account, we can basically test you basically X amount. So given the beginning balance, the purchase, and the ending balance, what's the amount of cost of goods sold that's reported during the period? Okay. This can be one example, or we can provide the cost of goods sold, which was $80,000, and we can erase this and make it X. So given the beginning, ending, and the cost of goods sold for inventory, how much did the company purchase for inventory during this year? That's another types of question that you can expect on quizzes and exams. Okay. Any questions on this? Good. So understanding that part, let's go to the income statement. Cost of goods sold is reported in the income statement. I talked about this previously, not in the balance sheet. It's not a balance sheet item. Okay, so basically cost of goods sold, again, is an income statement item. So let's look at the income statement. So far, when I described income statements, I usually wrote revenues by X amount, and then expenses by Y amount, and then net income of X minus Y. Very simplified version, and this is what we call a single step income statement. But when you actually take a look at the real world income statements, there are actually multiple levels of categories associated with the income statement. For example, this Best Buy, taking a look at this Best Buy company's income statement for 2017, okay? The company reports a total revenue of $39 billion. Okay, $39 billion. And below that revenue, you will able to see cost of goods sold. That's for the amount of $29 billion. So after deducting that cost of goods sold, the company will report this gross profit. Okay. So gross profit basically calculates the company's nothing but company's profits. Basically, it's the profit, okay, driving from selling the products. So the company reports it's $9 billion of gross profit. And below that gross profit, there will be other expenses that's reported. So for example, as I keep mentioning, selling, general, and administrative expenses, or what we call this SG&A. G&A. And for SG&A, there will be depreciation expenses, salaries expenses, rent expenses, and utility. So all sorts of expenses that's related to normal operations. So you need to, not need to have, but you will definitely have to report these expenses, salaries and rent, in order to operate your business. Okay. So for this particular example, the company reports about $7 billion of SG&A. So what that give you is the operating income. So after deducting SG&A, the company reports its operating income. And below that operating income, there are other revenues and expenses. So for example, there's the gain on sale of an investment, there's an interest expenses, and there are all sorts of other non-business operating expenses. And then after deducting that, the company will report this income before income taxes. And after paying taxes, the company finally reports this net income of $1 billion. So as you can see, there are multiple layers or multiple levels of profits that's reported in the income statement. And this is what we call this multiple step income statement. So let's take a look at how Tesla reports its multi-step income statement. So here, statement of operations, you're starting with revenues. So for this Tesla company, there are multiple types of revenues deriving from the operations. But at the end of the day, the revenue is reported by $24 billion. And below that, there's a cost of revenues or cost of goods sold. So the company is reporting all sorts of costs of goods sold. And as you can see right here, the company reports gross profit. So again, revenue minus cost of goods sold will give you the gross profit. And below that gross profit, there are operating expenses. So SG&A, as you can see right here, research and development and restructuring costs are also falls under operating expenses. So that will give you the operating income. Okay. So for our example, it was an operating income. For Tesla, it's actually not an income, it's a loss from operations because basically the expenses is greater than revenues right here. So it's actually a loss from operations. And below that, there are non-operating, non-business items that's reported. So interest income, interest expenses. So you have rather than reporting income before income taxes, there's a loss before income taxes of that amount. Okay, so at the end of the day, instead of reporting net income, there's a net loss. So again, this is a multiple step income statement. Whoa, why is it turning? But anyways, so this is an example of a multiple step income statement. Okay, so in your case, what you have to know is that so basically we can give you an example like this. Calculate the company's operating income. So let me just provide an example. So we'll probably, there will be like a table, for example, the table that has revenue of X amount, SG&A of Y amount, interest expenses, Z amount. Okay, the question might be asking, oh, important item, cost of goods sold of A amount. Okay, so given these items, calculate or compute operating income. Operating income. So given that question, you have to be able to pick this revenue and this SG&A and cost of goods sold, X minus Y minus A. That will give you the operating income. Okay. So again, you have to be able to memorize or understand that some of the items will not going to be included in your calculation depending on the types of question that you're getting. Okay. Any questions on this?
Because interest expense is a non-operating.
It's because it's a non-operating expenses.
Yep.
Any other questions?
Actually, would that be true for a bank?
Oh, banks is a whole different story. Now, I'm not going to get into detail with
Fine.
respect to the banks,
Drop
but let me
the
just,
question then about banks.
yeah, I mean, so if you're just a manufacturing or merchandise company, when customer give you cash, okay, that's an asset. Now for banks, if customer deposit cash, that's a liability.
Yeah, exactly. Yeah.
Yeah, it's a, yeah. You don't want to get into that detail.
I got it. Sorry.
Yeah. But actually, financial industries and banking industries are quite interesting, and it's actually has it probably occupies more proportion with respect to the country's GDPs and GMPs. But for Baruch's MBA master's course, we're going to focus on manufacturing companies. But if you want to pursue your career in financial services, you will have to learn these accounting principles. That's another level basically. But yeah, we're not going to be focusing on that. Okay, but that's very interesting. When a company receives cash, if you're a manufacturing company, that's an asset. For banks, it's a liability. Now there are, oh my God, so many questions. So Brooks asking, don't they record it as deposits? No, when the company or when a customer deposits their cash in the banks, that's a liability. Yeah. Okay. But again, financial services, banking industry, I'm not going to touch on that because that will drive you guys nuts. And then for CPA exams, I don't know how many of you are going to be taking CPA exams down the road. I don't think the CPA exam as well going to cover accounting principles related to financial services. So unless you have some expertise or unless you are pursuing your career in this financial services, yeah, you don't really have to know the whole new set of accounting principles that applies to financial services industry. Okay. My CPA exam day. Oh, good luck, Yupang. So that was the multiple step income statement. So again, what your responsibility will be able to identify which item falls under gross profit, which item falls under operating income, which item falls under income before income taxes. Now, technically, if you look at the real world exam, the financial not financial statement, for when you look at these financials, I don't know how many of you heard of it, but we usually have this metric or financial metric called EBITDA. Okay, I don't know how many of you have heard this or EBIT. So basically, this one indicates earnings before, oh my God, I have to write this, earnings before interest, taxes, depreciations, and amortizations. Okay, so basically that EBITDA talks about closely related to operating income, but not technically the same, but kind of similar. So how much the company made a profit by operating expenses, but not including this interest or taxes and depreciation, amortization. So if you go to the real job, you might usually use this term EBITDA rather than operating income when you're analyzing companies. Similar idea, EBIT is earnings before interest and taxes. So that's another key metric or key financial metric that you are going to be using when analyzing companies' financials. But just wanted to provide you some terminologies that a lot of financial professionals use in their job market, in the job setting. Okay. But for this course, you don't have to know these terms, but just know that we have gross profit, operating income, income before taxes. Okay. Any questions? Okay. So which level of profitability is considered profit from normal operations? So when you're talking about profits or earnings for normal operations, you're most likely talking about operating income. Okay. So determine the cost of goods sold and ending inventory using different inventory cost method. Okay. So now here comes the trick part. Let me draw a refrigerator, not refrigerator, but a vending machine, I guess. Vending machine. Okay, I'm a terrible drawer. I'm just gonna do a towel. So you have a towel. Tower. What example should I use? Let's just use iPhone. So this is an iPhone stack. So you have iPhone inventory number one, you have another iPhone inventory number two, you have another iPhone number three, you have another iPhone number four. Now, so far, we have been assuming that the costs of producing iPhones for number one, number two, three, and four are the same. Okay. So the cost of raw materials for these four types of iPhones, or same iPhones but different stacks, are the same. The electricity bills and labor costs, we have been assuming that these all costs are the same for different stacks of inventory, in this case iPhone, but in reality the costs vary all the time. For example, we have oil. Okay, not particularly with respect to this iPhone, but oil prices fluctuate all the time. If oil prices changes all the time, your cost of producing some goods will change as well. So given these changes in the costs of an inventory, how are you going to report your cost of goods sold? That's the question that we will be discussing going forward from slide 18. Okay, so in accounting, there are by and large four ways to measure this cost of goods sold, starting with specific identification. So what that means is that there is a computer system that basically tracks which inventory has been sold during the year. So let me just give you an example here. So assuming that this iPhone stack number one, the cost is 7. This iPhone stack number two is 8, 3, 9, 4, 10. So using the specific identification system, let's say if iPhone stack number two is sold during 2021, that means the company will report this cost of goods sold of $8. Okay, that's the specific identification system. Now, as technology advances and this powerful computer processing capabilities, some companies are starting to use this specific identification system, but we are not there yet. Okay, so we have to come up with some ways to basically compute the cost of goods sold. So let's start with first in, first out. So what that means is that, so since this number one stack is the oldest stack, and this number four is the newest stack, if a company adopts this first in, first out approach to measure the cost of goods sold, what that means that during the year, the company will assume that number one stack was sold first. And if number one is sold, then the company will move on to number two. Okay, so you're starting from the bottom to the top as you're making sales during the period. That's first in, first out, using the oldest inventory to compute the cost of goods sold. Now, In contrast, if a company adopts this last in, first out, or LIFO, what that means is that the company assumes that the newest or the latest items of inventories are going to be sold first. So you're starting with 4, and if all of the 4 is sold, you're going to move on to 3, okay, as to compute the cost of goods sold. So it's just basically different assumptions. Are you going to use your oldest inventory to make sale to compute the cost of goods sold, or are you going to be using the newest items to compute the cost of goods sold? If the company does not like either of these approach, obviously there is a average method. So basically you compute the weighted average for this tower and then just multiply that with the number of items sold during the year. Okay. So any questions before we get into the actual calculations? Okay.
Can you say like what would be the reason for one company to choose one version over a different version?
So let me draw a graph. Cost. I mean, because of the inflation, because of the rising cost, let's just assume that the cost of inventory rises. Okay, that's just an assumption. It can definitely go down because of the advances in technology or the use of robots instead of humans to produce to manufacture items. But let's just first assume that the cost of producing goods is rising. So if the company how come it's not recognizing? Oh, there you go. So if the company adopts this FIFO approach, first in, first out, what that means is that the costs of the goods sold will be centered around here. You're going to be using older items. So what that means is that the cost of goods sold will be relatively lower compared to other companies. Now, on the flip side, if the company adopts this LIFO approach, or last in, first out, what that means that the company will be using the latest items centered around here that has a higher cost. So you're reporting a higher cost in your income statement. So if you're reporting higher costs, what that means is that you're going to be recording lower net income, which will have an impact on the taxes. Okay, so most of the time, the companies that chooses this LIFO will be doing this to lower the taxes. That's one strategy. But that's basically it, because the cost of an inventory will change all the time, depending on which approach you're getting. Your tax, you will have some tax implications and income statement implications as well. Okay. Any other follow-up questions? Okay, so why don't we get into the real world example, not real world, but let's get into the example here. So assuming that in the beginning of the year, the company had an inventory of 100 units at the cost of $7. So what that means is that you have $700 of beginning inventory in the beginning of the year. On April 25th, the company purchased additional 300 units for that same inventory for the cost of $9 each unit. So what that means is that the company is increasing inventory by $2,700. On October 19th, the company purchased additional inventory for 600 units at $11. So as you can see, there is a increasing dollar amounts with respect to the unit cost, and that's $6,600. So what that means is that during the year, the company has a total of 1,000 units for that inventory for the amount of $10,000. Okay. Now, during the year, on July 17th, the company sold that inventory for 300 units. Okay. Now the question becomes, for that 300 units, how much are you going to be recording for the cost of goods sold? That's the question that we are learning at this point. Now, on December 15th, the company made another sale for 500 units. Again, the question is, given this information and given the different method the company adopts for computing cost of goods sold, how much are you going to be recording for the cost of goods sold for that $500 units? And depending on which approach you're getting, the cost of goods sold will be different depending on the method. Okay. So why don't we do the calculations? So from now on, there will be a bunch of calculations. So if you can stay focused for the next 15 minutes, that will be really helpful. So whenever I explain chapter 6 with respect to these transactions or inventories, I always like to use this tower approach. Okay, so here on January 1st, you have a beginning inventory of 100 units at $7. Okay, on April 25th, you have another stack of inventory, 300 units and $9. And on October 19th, you have another stack of 600 units at $11. So that's going to be your starting point. Now, so for July 17th, so let's first assume that the company adopts FIFO approach. So that's the first case. If the company adopts this FIFO approach, that means that on July 17th, my handwriting, on July 17th, you are using your 300 units, and that 300 units will come from this 100 units. Okay, you're going to use the oldest unit, and you still have 200 units to sell. So you're going to take some from the second stack of 200 units. Okay, so for the cost of goods sold using FIFO method, the cost of goods sold will be 100 units times 7, 200 units times 9. So that's 700, that's 1800. So in total, the company will report cost of goods sold of $2,500 if the company uses FIFO method. Now I'm going to compare that with LIFO method. So if the company adopts this LIFO method on July 17th, you're still selling the same 300 units, but in this case, you are going to be using the newest item instead of using the oldest. So you had 600 units of the latest items, so you can just take everything from here. So entire 300 units times $11 per unit. So that's a total of 3,300 of cost of goods sold. So as you can see right here, depending on which method the company adopts, the cost of goods sold that the company will be reporting will be different, either $2,500 or $3,300. Okay. I think there is a question, but in July, you wouldn't have brought the October inventory. Now, I'm going to talk about that later on, but that's a very good question. But I'm going to talk about that. So Gerardo, please hold on that question. Okay. But this is basically the idea. Okay? Any questions on this calculation? Okay. So this was FIFO. This is LIFO. So we have another method, weighted average. So for weighted average, let me go up. Okay. So basically the first job for weighted average is to calculate the average, right? So we have a total, we have 6,600 in total for that inventory stack. We have 2,700 for that second stack. The first stack is 700. So in total, Let me do it quickly. So that's $9,000 of total inventory divided by the total number of units. So that's 1,000. You have a total of 1,000 units. So what that gives you is that you have $9 per unit for that inventory, the weighted average. So given this $9
That's
for
10,000, no?
10,000? No,
Yeah.
you have.
That's what the slide says.
That's what the slide said. Oh, where did I make up?
10,000. 6,600 plus 2,700 plus 700 should be, I think.
Oh yeah, that's right. Sorry. So that's 10,000. Let me just change to $10. Okay. So given this $10 per unit, you can easily calculate $10 per unit times you sold 300 units. So that's total $3,000 of cost of goods sold. Okay. Now, some students make a mistake by just simply averaging this 11, 9, and 7. Don't do that, okay? You're supposed to calculate the weighted average. So you are supposed to first calculate the total dollar amount of your inventory, divide that by the total number of units in order to get the weighted average. And using that weighted average, multiply that with the number of units sold, that will give you the cost of goods sold following weighted average method. Mhm. Any questions on this? Okay, that's good. I didn't, okay. So that was for cost of goods sold. Now, let me draw T account. So we're gonna go back to this FIFO method. So using FIFO, let me draw T account. We had a beginning inventory of 700, as you can see right here. We don't know the ending inventory yet. Okay, we don't know, but we purchased a total of, let me just do 9,300 according to this information. Now, we just calculated the cost of goods sold using FIFO, which was $2,500. So the cost of goods sold was $2,500. This is inventory. So at the end of the day, the ending balance of inventory should be 7,500. Okay. Now let's use LIFO example. LIFO, you have another T account for inventory starting with 700. The purchase was 9,300. And according to this, we calculated the cost of goods sold for LIFO as 3,300. So instead of reporting 2,500, you're going to be reporting 3,300. So at the end of the year, the ending balance of your inventory will be 6,700. Now let me just do one more weighted average. So you have another inventory starting with 700, purchase 93. And if I remember correctly, the weighted average method will give you $3,000 of cost of goods sold. So you're going to be reporting 3,000 on the right side. So that will give you 7,000 ending inventory. Okay. So depending on which method the company adopts, your cost of goods sold will differ, as you can see right here. And naturally, if your cost of goods sold will differ, your ending balance will also change according to the amount of cost of goods sold that you are reporting. Okay. Any questions on this? Okay. So I think we're pretty much good self. So this is basically reiterating what I just discussed. So you have a stack of inventories, and depending on which inventory you are going to be using, you have different numbers for cost of goods sold and the ending inventory. Okay. Now, many students find it surprising that companies are allowed to report inventory costs using assumed amounts rather than the actual amounts. So again, so if the company implements the real-time tracking system per se, you can definitely calculate the exact amount of an inventory. But because we don't have that technology yet, we can basically assume using the best guesstimate. So if the company adopts FIFO, they will give you a cost of goods sold. If the company adopts LIFO, they will give you another amount for the cost of goods sold. Okay.
As a you know, as a technical matter, I understand for accounting purposes we have to know LIFO versus FIFO. As a practical matter of running a corporation, do costs really change that much generally in a low inflation environment that it's so significant? Or
Wow, let's take a look at Tesla. I don't know whether
Okay.
Tesla has that. No. Okay. Item 8. I don't think Tesla will give you which method they're using. Not loss. But look at this, the cost of revenues or the cost of goods sold. The total revenue was $24 billion. Now the cost of goods sold in this case is $20 billion. So cost of goods sold actually has a chunk component associated with it. So if you are changing your method to estimate the cost of goods sold, that will definitely has a huge impact on company's financials, and that will also impact how much the company pays for tax purposes. Yeah, I mean, if you are just service company, I'm sure the cost of the services will not going to be that significant. But if we're talking about manufacturing companies, yes, cost is a big chunk component with respect to the net income or net loss. I have Apple. Let's take a look at Apple. So item 8, statement operations. So the revenue or net sales was $260 billion. Okay. Cost of sales is again $161 billion. So as you can see right here, cost of goods sold, it means a lot to manufacturing companies. Can companies change? Okay, another question. Can companies change their method year by year? No. Once you adopt one method, you have to stick to the method unless there is a significant reasons as to why the company has to change the method. But if the company decides to change the method, the auditor must agree with the change, and the ACC, who's overseeing this financial statement, will also have to agree. Okay. Any other questions? Okay. Now, there's a sample question here. So a company has the following inventory transactions. So the company reports the beginning inventory of that. You have purchases for this unit. What would be the cost of goods sold under FIFO method if 120 units were sold in January? So like I discussed previously, I always start with a stack of inventory. And I think this visual aid or visual illustration will definitely help you when you're actually doing your exams and quizzes, and I guarantee it. So you're starting with 100 times 4. You have another purchase, 100 units times 5, another units of 100 times 6. Now, according to this, the company adopts FIFO. Okay, FIFO, and 120 units were sold. So what that means is that you're going to be taking the entire 100 units from the first stack, and you're going to be taking 20 units out of the second stack. Now for the cost, you multiply 100 by 4, you multiply 20 by 5, so that will give you a total of cost of goods sold for 100 plus 100. So that's 500. Hopefully did I correct it? So 500. Okay. Same question, but if the company adopts LIFO, let me do LIFO methods. So let's go down a little bit. So if the company adopts LIFO, you're going to be using the latest stack right here. So that's 100 stack times 6 plus you're taking 20 units from the second stack. So that's total 700. Okay. Weighted average. So like I said previously, do not do simple average. So you have 6, 5, and you have 6, 5, and 4. The average is 5. That's not the case here. You always have to do weighted average. The total cost of goods that you purchased during the period divided by the number of units. That's the weighted average. Okay. Simple average. So depending on which method we're using, I'm going to be explaining the impact, basically the impact on the financial statement and the implications on tax, and the amount of the amount of taxes the company will be paying from the net income. So let me just again draw costs here, time trend right here. So if the company adopts this FIFO method, what that means is that the company is actually matching fiscal flow for most of companies. So what that means is that, so I don't know whether you actually went to Walmart or Target, there will be shelf here. I don't know whether I can draw. Well, let me just largely draw. So if you're running Walmart, there will be items stacked right here, okay? When the company stacks their items for sale, usually they put the new ones in the back, okay? And then they usually rearrange their items that has the shortest expirations, okay? They wanna sell off their old items as soon as they can. So how they arrange their items is that they always put the new items in the back and then put the oldest items in the front so that customers actually pick out these older items instead of these new items. Basically, this is it. So if the fact that the company is adopting FIFO is that the company is actually matching this fiscal flow. And then what also means is that the ending inventory reflects the current cost. So using this graph, if the company is following FIFO, so they are spending or they're using most of their items for sale on this first part. So what's left at the end of the year is mostly centered on this. So the ending inventory for that company will be closely matched with the current cost of an inventory, right? So since the ending inventory reflects the current cost, we usually treat it as a balance sheet approach. The ending inventory reflects the current cost, and that's why this is called a balance sheet approach. Now, if I just erase this and then change to LIFO method, what that means that as you're selling your items, the most of the items that are being sold are going to be centered around here. And what that means is that the ending inventory will be mostly on older items with lower cost, for example. So in this case, the cost of goods sold here, instead of ending inventories, reflects the current cost. So since this cost or expenses is more related to this current cost, we call it an income statement approach. Okay. Now I explained this previously. What's the advantage of using FIFO? What's the advantage of using LIFO? Assuming that the cost of inventory is increasing throughout the period. If the company adopts LIFO, as you can see right here, that means you have a higher cost of goods sold. Now that translates to lower net income. Now that will have an impact on tax payments, so lower taxes paid. Okay. But something that to keep in mind, that if the company uses LIFO for tax reporting purposes, the company also have to use this LIFO method for financial reporting purposes. So you cannot just use LIFO method for tax to lower the tax amount and FIFO for financial reporting. There has to be some consistency. Right? Any questions so far? Okay, that's good. No questions. So basically, this is the summary of what we've been discussing. So depending on the choice of the inventory method, your cost of goods sold will have a different dollar amount, and that also will have an impact on your ending inventory. Okay, that's basically it.
Professor,
Yeah.
I just had a quick question. So I think you went over the benefits of FIFO and LIFO. Are there any benefits to weighted average from a balance sheet or income statement perspective?
Personally, I have never seen companies using weighted average method. I'm sure there are going to be some companies using weighted method, but predominantly most companies use FIFO for their
Gotcha.
financial reporting purposes. Yeah.
Thank you.
Yeah. Any other questions? Okay. And the last thing that I want to cover before we take a break is that, okay, so we know that there's a LIFO, there's a FIFO, there's a weighted average. Now, but the whole purpose of this of learning accounting or auditing is that investors want to compare between companies or among companies. So let's say you have Walmart, for example, and you have Target. If I assume that Walmart uses FIFO and Target uses LIFO, you cannot really compare the cost of goods sold between these two companies. And as we saw from Apple's and Tesla's financial statement, cost of goods sold is a large number. And depending on which method you're using, the cost of goods sold dollar amount will change significantly. So let's say if Walmart uses FIFO and Target uses LIFO, you cannot really compare between these two companies. So what the SEC mandated the company to do is to report in the notes this what we call a LIFO reserve. So what that LIFO reserve indicates that had the company adopted LIFO method, what would be the ending inventory amount? Okay, so again, like I said previously, most of the companies adopt FIFO, as you can see right here. Following the physical flow of an inventory, the company usually report this FIFO inventory dollar amounts in their financial statement, but because of the fact that some other companies might be using LIFO for their financial reporting purposes, the company also reports its LIFO reserve to explain that if the company had adopted this LIFO method, what would be the ending inventory on the LIFO? As you can see right here. So for FIFO's inventory, the ending inventory is 7,800. Had the company adopted LIFO, the ending inventory will decrease by 1,200. Okay. So this notes to this financial statement is provided for investors for them to be able to compare between companies that adopt a different approaches. Okay. So, but that LIFO reserve is basically the difference between these two.
Professor, if you
Yeah.
use a LIFO method, can the inventory expire? Do you ever write off inventory?
Oh yeah, we're gonna talking about LIFO. I mean, some inventories will expire. We're talking about, for example, if we talk about food items that has an expiration date, in that case, there will be a write-off, of course. For iPhones or any other electronics items, for example, there are not going to be a write-off with respect to an expiration. But for food or some other items that has an expiration date, yes, definitely a write-off.
Thank you.
Any other questions? Okay, so I think this is a great place to take a break. So it's 7:40. We'll take a 20-minute break. So we'll resume on 8 o'clock. Okay. Let me stop.